Hello everyone, I hope you are doing well, and today I wanted to talk to you a bit about compound interest and what is also called the snowball effect. This is one of the main drivers in stock investing, and the power of it is crazy. If you're a young person and you're thinking about investing, I highly recommend you to watch this video so I can show you the true power of what compound interest can do. Now, in order to begin this, I want to show you the S&P 500. Now, what the S&P 500 is it will say here, it's the Standard & Poor's 500, or simply S&P 500. It's a stock market index tracking the stock performance of the 500 largest companies listed on stock exchanges in the United States, and it's one of the most commonly followed equity indices. This is what a lot of people consider to be the market. If people are trying to outperform the market, this is usually what they're trying to outperform. But the way to look at the general market, no sort of analysing of specific stocks, just the general market as a whole, and you don't want to spend any time sort of trying to find certain stocks that are maybe cheap or at good value. You just want to go in with the market price, and you want a whole chunk of the market so you're well diversified and there's not massive risk with it, because if one does badly then the other 499 are still there to protect it. This is what the S&P 500 is. Now what I have here is a start year of 1923, and I just want you to focus on this number here for now, this 10.39% per year. That is how much the S&P 500 has grown per year on average since 1923. So a 10% compound interest is about what to be expected. But if you think that maybe it won't always be like that, it's not always going to stick around 10%, well, it's actually pretty common. We change this date to, instead of 1923, 1950. No, not 1950, calculate 11% that year. Since 1950, it's been 11%. Since 1980, it's been 11.5%. And maybe we just think, okay, so let's just look at the last 20 years. How's it been since then? Well, since 2003, calculate it again, it's around that 10% mark. It's very, very consistently staying around roughly that 10% mark. If we're going to use that as a benchmark, I'm going to show you the S&P 500 here. You can see just how much it's called an exponential growth. So you can see it looks like it's slowly growing at the start. The line's kind of flat, and then it starts to climb much, much faster in recent years. And that is because of compound growth. I want to show you this. This is a $10,000 initial payment. You can see that down here, $10,000 initial payment. That's staying $10,000 throughout. And if you're then contributing $10,000 each year on top of that, you can see that your contributions are rising by $10,000 each year. But have a look, this is 8 years at a 10% rate of return, which you can see is pretty common for the S&P 500. You can look at 8 years, this interest earned is increasing by more and more each year, and this green bar is slowly catching up to the blue bar. And if we keep increasing these years of growth, if you invest now, so I'm 24, this will be when I'm 34, it would have been 110,000 put in if I was to start with 10,000 and contribute 10,000 each year. You're going to see at this point it's 75,000 interest earned. But watch that green bar, it's just growing. 75,000 goes to 93,000. That's an 18,000% increase. Obviously your increase is still only the 10,000. Watch, it went from 59 to 75, so it went a 15 or 16,000 increase into a 18,500 increase, and that's going to keep going. And I told you, as you go a few more years, if we go to 20 years, which will be around the time that I'm in my 40s, you can now see the green bars massively overtaking your contributions. Contributions at 200,000, your interest is at 430,000 at this point. This is the power of compound interest, because now you can see each year of that 10% compound annual growth rate that you're getting, that's now paying you interest alone. You're getting 60,000 nearly just from that growth. And as I say, if you just increase this a bit more, you watch this number, your total balance 714,000. It's just jumping rapidly now. 80,000 increase, 100,000 increase, over 100,000, and that's just going to keep happening. So here, by the time I'm looking to retire around 50 or maybe earlier, if I was contributing this amount, I'd have $1 million in the portfolio. And now what you can do at that point is if it's a 10% annual growth rate, you can start to take out maybe 4% at a time. You're still going to see growth in your overall portfolio, but you're taking out a very nice chunk of money each year, and you'd be very comfortable to retire on an amount like that with not a crazy amount invested. If you're just putting £10,000 or $10,000 in each year, is obviously a lot and not possible for many people, but for many people it is, and I highly implore you to start investing, because this snowball effect is absolutely crazy, and if you keep up with your investments, you're going to be rewarded. Look at how the green bar just grows, and now you don't even need to be making this 10,000 contribution anymore, because the interest is just way more than that 10,000's ever doing. And you just watch how the graph slowly starts off flat, more horizontal, and starts to boom vertically. That right there, that is the compound interest snowball effect. And it's not like it's nothing that happens regularly. This 10%, you can see, even if we go over the last 10 years now instead, again, it's at 12.9% in the last 10 years. This isn't something which has ever been terrible. You'll have bad years, the market goes up and down. You can see year to date, this year, not year to date, the last year, sorry, it's fallen over the last year, but there's so many falls in the graph. Right here in 2000 it was at 1,400, dropped all the way down to nearly half that at 800. But if you keep investing during this period, that's what you've got to remember. You can't stop your contributions. Keep adding your contributions while it's low, and then when it does start to rise again, you'd have invested a bunch down here, and then you're catching all of this rise. And again, keep investing slowly your money, and the interest rates. You don't want to leave things in a savings account, because you might get 1% interest in your savings account. What's inflation this year? Inflation 2022 or 2023, let's have a look. So increased from 5.7% to 5.8% in the UK. If you're in a savings account that gives you 2% back, then you have now lost effectively 4% of the money that was in that account, because inflation's at 6%. Let's have a look at what it is right now in 2023. Does it have it here? Interest rates rose by 10% in January 2023. As you can see, interest rates, and yeah, inflation rate, here you go, rose in January more than expected and up 6.4% from a year ago. It's nothing is unpredictable. Yes, the market's going to go down, it's going to go back up, but if you consistently contribute, or even if you just leave an initial amount in there, over time this investment is just going to grow and grow. Because say you put in £100, let's dial it back to 1 year, and let's just say no contributions. You put in £10,000, here we go, and you'll get £1,000 interest on that. But then the second year, you're also getting interest on that 1,000, or not interest, but you're getting that 10% is then also on that 1,000. And now it's grown by the additional 100, which is on that 1,000, and then again you've got an extra 1,100, and you're getting that extra bit, that extra chunk. Well, this green bar, you'll see your interest slowly rise each year, and after 10 years, that 10,000 you put in is, if you never touch it again, it's now worth even more than it was when you started at 15,000. And I think it's so important to know about this compound interest, this snowball effect, if you want to start investing. And if you are young, this is clearly, and even if you're not young, if you're thinking about it, I think you should just get your foot in the door, because the earlier you start, everyone always regrets not investing earlier. Everyone that invests, you ask them what their biggest regret is, they'll say, I wish I started earlier. Because if you do, the time is the absolute most effective tool in the stock market. We had more time than everyone could go on to be millionaires, because as you can see, if we add the years of growth, even on that 10,000 initial investment and you never touch it again, if you had time, you could be a millionaire. 49 years, it's not outrageous. If you gave a newborn baby $10,000 as a birthday gift and stuck it in the S&P 500, and when they were 50 and ready to retire, they'd have a gift which is worth $1 million based on this 10% rate of return. And I've shown you in the S&P 500, this is not something which is unexpected. This is what has been seen over the last 100 years, the last 80 years, the last 50 years, the last 20 years. It's consistently at that 10% mark. I hope that this has shown you something and piqued your minds, and you're interested now, or maybe you were already interested and it's just confirmed things. But I hope you enjoyed this video. I hope you learned something. If you have anything to share or you have any comments, let me know down below. Subscribe, and I'll speak to you again soon.